Let's talk about this market in an honest way. The January 2026 numbers are weak. And this time they are weak for a reason. Sales are down, home prices are lower compared to last year, January 2025, and homes are taking longer to sell. And this is not just a housing story. Actually, this time it's economic one. So instead of reacting to the headlines, let's slow down, look at the data, and try to understand what the data is telling us clearly and calmly. My name is Ilham Ibrahim. I'm a real estate agent in the Greater Toronto area. My goal is not to push people to buy or sell. The true goal is a clarity before decision, because the real estate decisions are emotional, expensive, and it's hard to undo. So if you are here, it means you want to understand before you act. Welcome back to the channel. So what this market is really reflecting. Before we dive deep into the details, here's the big picture. Currently, Canada is going through a quiet recession. Not a dramatic collapse, but a prolonged period of weak growth, lower confidence, and delayed decisions. So the economic growth of the past year has been close to 1%. Actually, the economy contracted in 2 of the last 3 quarters. And the interest rate cut that's been happening in the last few years have not revived activities. And the real income growth remain under pressure, and the GDP is still declining. And let's be real, the housing market is reacting to this reality. It's not panicking, but it's pulling back. And this is a market shaped by caution, affordability pressure, and uncertainty about what comes next. Now let's break this down properly. To understand the housing market today, we have to understand the economy behind it. Even though interest rates have been cut roughly around 2.75% points since 2024, but the impact has not been limited. And that's because most Canadians, they don't borrow at overnight rates. And mortgage rates, business loans, and consumer credits have not fallen enough to meaningfully stimulate demand. And as a result, the real GDP is still declining. And that means, on an average, Canadians are becoming poorer. And inflation is no longer an issue. Currently, it's around 2.4% now. In fact, the bank expects a disinflationary output gap to persist through at least 2027. And this tells us something important. The problem is not overheating. It's a weak demand. And in that kind of environment, most people postpone big decisions like moving, changing career, changing country, having a baby, getting married. So why the interest rate cuts have not revived the housing market? Normally the housing market is one of the sectors that respond to a lower interest rate. But that has not happened. Home prices nationally all across Canada have been declining in the last 10 months in a row. We are running roughly down 2% year over year. And residential construction is still flat. And retail sales have shown almost no real growth. All these sectors are interest sensitive, but they are not responding. If that tells us something, it tells us interest rate cut alone is not enough to restart momentum. And affordability is still stretched. Let's dive deep into the details. Let's start with the sales activity for the month of January 2026 in the area of the GTA. So TRAP reported 3,082 sales activity for the month of January 2026, and that represents 19.3% decline compared to sales in January 2025. Sales in January 2025, it was 3,820. And this is not a distress selling, it's actually a buyer hesitation. The new listing reported 10,774. And this is also down 13.3% compared to January 2025. If that tells us something, it tells us that many sellers are choosing to wait, list their home for sale rather than test a cautious market. Active listing reported 17,975, and that went up 8.1% compared to last year. And that tells us that inventory is rising slowly, but not flooding the market. This is what recessionary housing market looks like. Not chaos, but restrained. The average home price in the GTA now is around 973,000. And this is down by 6.5 year over year. And the MLS home price index also is down 8%. This is not a crash, this is repricing. Prices are adjusting to what actually a buyer can afford in a low growth, high uncertainty economy. Let's break down the numbers by home type. Detached homes went down 13.6%, and the prices went down 7.4%. Semi-detached homes in the GTA area, sales went down 19.2%, and prices went down 9.7%. Townhomes in the GTA area, sales went down 23.7%, and prices went down 9.4%. And condos in the GTA area, sales went down 26%, and prices went down 9.8%. Condos remain the most vulnerable market so far, especially with investors are stepping back due to financing costs and weak cash flow. So what does all these numbers really mean? Today's housing market is not broken. It's reflecting a weak economy, a quiet and a slow recession, a cautious consumer, and a reset in expectations. So if you are a buyer watching the market closely, I want to tell you something. This environment favors patience and clarity. And opportunities are still exist, only if you understand where leverage actually is. And before you make a decision, make sure your move is based on data, clarity, not emotions. If you like this video, I would highly appreciate it if you subscribe to the channel, like, share, comments. Thank you for watching, and I will see you in the next video.